There is a dissonance in the financial world right now, a profound gap between what is being said on the television screens and what is actually happening in the ledgers of the world's most powerful institutions. If you were to judge the state of the global economy purely by political headlines over the last few years, you would be forgiven for believing that the United States and China were in the process of a complete and total divorce. You would see trade tariffs, aggressive rhetoric, sanctions on technology exports, and a general consensus across the political spectrum that the era of cooperation is over. The narrative is one of decoupling, of America pulling back, securing its borders, and revitalizing its own industrial base, while freezing out its primary geopolitical rival. But if you turn off the sound of the political theater and look solely at the movement of capital, you see a completely different reality. At the very height of the trade tensions, while the world was distracted by the spectacle of diplomatic posturing, the plumbing of the global financial system was being repiped. During the exact period that Washington was ostensibly locking the door, Wall Street was quietly opening the floodgates. We are talking about trillions of dollars in capital flow, not a trickle, but a torrent moving from Western portfolios into Eastern markets. This wasn't an accident. It wasn't a clerical error or a momentary lapse in judgment by asset managers. It was a calculated, algorithmic, and systemic shift that represents the next phase in a cycle that has been repeating for centuries. To the untrained eye, this looks like hypocrisy, or perhaps simple corporate greed. But to those who study the long arc of financial history, it looks like something far more significant. It looks like the inevitable migration of capital that occurs when a dominant economic cycle reaches its mathematical limit. We are witnessing a phenomenon that has toppled empires and restructured the global order multiple times in the last 300 years. It is a mechanism that operates independently of patriotism, ideology, or hope. It is the cold, hard logic of liquidity, seeking safety, before a structural collapse. We need to talk about the life cycle of a reserve currency and the behavior of the financial elite when that currency enters its twilight years. Most people operate under the assumption that the financial system is a static, permanent fixture, that the money in their pocket today means the same thing it did 20 years ago and will mean the same thing 20 years from now. But history tells a story of constant flux, a story where the center of financial gravity shifts from one geography to another, usually preceded by a period of excessive debt currency debasement and a final desperate attempt to maintain the illusion of control. Understanding this mechanism requires us to look past the daily fluctuations of the stock market and examine the foundational architecture of money itself. The pattern we are seeing today is not unique to the 21st century. We saw it in the transition from the Dutch guilder to the British pound, and again from the British pound to the US dollar. In every instance, the process follows a distinct rhythm. It begins with the establishment of a robust financial system that generates immense wealth. It transitions into a period of hubris where that wealth is used to finance expansion, war, and social programs through the accumulation of debt. And it ends with a period of overextension where the cost of servicing that debt forces the debasement of the currency, triggering a flight of smart capital to the next rising power. We are currently living through the later stages of this cycle. To understand where we are going, we have to understand how the machine was built, how it was corrupted, and why the smart money is positioning itself for a reality that most of the public refuses to acknowledge. This is not about pessimism. It is about pattern recognition. And the pattern is flashing red. Let us go back to the prototype of the modern central banking system to understand the trap we are currently in. The model that governs our current economy was essentially born in London in the late 17th century. The innovation was simple but revolutionary: the marriage of government debt to private banking. A central bank was created to loan money to the state, and in return the state gave that bank the monopoly on issuing currency. This allowed the government to spend money it didn't have to tax for or finance wars and expansion, that would have otherwise been impossible. In the short term, this system is a miracle. It unleashes productivity, funds technological leaps, and builds navies. It created the British Empire. However, this system has a flaw buried deep in its foundation. Because the money enters the economy as debt, the system requires perpetual growth to prevent collapse. The moment the empire stops expanding, the debt Britain becomes mathematically unpayable. Britain hit this wall in the early 20th century. After centuries of dominance, the cost of maintaining a global empire combined with the devastating expenses of World War I shattered the kingdom's balance sheet. They had two choices: default on their obligations and admit bankruptcy, or print the money to pay the bills and destroy the value of the pound. Like every empire before and since, they chose the printing press. But here is the crucial detail that is often omitted from history. Books, the architects of the system, did not go down with the ship. As the British economy began to groan under the weight of its debts in the late 19th and early 20th centuries, British capital didn't just vanish. It migrated. The banking families and merchant classes of London saw the writing on the wall. They saw a rising industrial power across the Atlantic, the United States that had a cleaner balance sheet, abundant resources, and a demographic trajectory that promised growth. While British politicians were giving speeches about the eternal glory of the Empire British, wealth was quietly financing American railroads, American steel mills, and American factories. By the time the pound sterling officially lost its status as the world's premier reserve currency, the wealth that had once been concentrated in London had already effectively relocated to New York. The population of Britain was left to deal with the austerity and the currency devaluation, but the capital itself had survived by moving. The allegiance of capital is not to a flag. Its allegiance is to yield and security. When the host organism becomes too laden with debt to survive, Kiel finds a new host. This brings us to the second major historical pivot, one that is perhaps even more relevant to our current situation. The 171 severance of the US dollar from gold. For the first few decades after World War II, the American system worked beautifully because it was anchored in reality. The dollar was backed by the largest gold reserves in history, and the world trusted it as a proxy for hard assets. But the temptation to overspend is a political inevitability. Between the Vietnam War and massive domestic social programs, the United States spent far more than it could afford. The gold reserves began to drain away as foreign nations demanded payment and hard assets rather than paper promises. When the gold window was closed in 1971, the nature of money changed fundamentally. The discipline was removed. Without a physical tether, there was no longer a theoretical limit to how much debt could be created. The dollar became a pure fiat currency, backed only by the faith in the US government and the demand for oil. This unleashed a 50-year supercycle of debt expansion that created the illusion of permanent prosperity. We could consume more than we produced, import more than we exported, and cover the difference by simply issuing more treasury bonds. But we must ask ourselves, what happens when the rest of the world stops wanting those bonds? What happens when the exorbitant privilege of printing the global reserve currency reaches its saturation point? We are seeing the answer unfold in real time. The debt-to GDP ratios have climbed to levels that are historically associated with sovereign default or hyperinflation. The interest payments on the national debt are becoming one of the largest items in the federal budget, competing with defense and social security. The mathematical runway is running out. This is where the behavior of modern financial giants becomes the ultimate signal. In the last 5 years, we have witnessed a strange duality. On the surface, the geopolitical relationship between the US and China has deteriorated. We have seen a trade war that imposed tariffs on hundreds of billions of dollars of goods. We have heard politicians on both sides of the aisle compete to see who can be tougher on Beijing. The optics suggest a complete separation. Yet, if you look at the actions of the entities that actually control global capital allocation, the index providers, The major asset managers, the investment banks, you see the exact opposite. During the peak of the trade war turmoil, major global indices began aggressively increasing the weighting of Chinese equities and bonds. This is a technical detail that sounds boring, but its implications are earth-shattering. When a major index provider like MSCI increases the weighting of a country in its emerging markets index, it forces trillions of dollars of passive capital to move pension funds, endowments, and sovereign wealth funds that track the indices are contractually obligated to rebalance their portfolios. They don't have a choice. By altering a few lines of code in the index methodology, the financial gatekeepers effectively routed a massive river of Western capital directly into the Chinese financial system. While the news anchors were talking about tariffs protecting American jobs, American capital was building the financial infrastructure of the East. Major U.S. investment banks were securing licenses to operate fully owned subsidiaries in China. The world's largest asset managers were urging clients to increase their exposure to Chinese markets, citing them as a necessary diversification tool against the devaluation of Western currencies. This is not a conspiracy. It is open institutional strategy. They are looking at the same balance sheets we are. They see a Western system that is leveraged to the hilt, reliant on 0% interest rates and facing a demographic crisis. And they see an Eastern competitor that, despite its own significant risks and flaws, represents the next engine of global growth. The logic here is brutal, but consistent. Capital flows from areas of low growth and high debt to areas of high growth and potential yield. The United States has spent the last several decades financializing its economy, turning it into an engine of debt creation rather than production. We have hollowed out our industrial base in favor of financial services and consumption. China conversely spent that time building the physical plant of the 21st century. Now, as the US dollar faces the inevitable consequences of decades of printing, the smart money is hedging its bets. They are not abandoning the US entirely, that would be premature, but they are aggressively diversifying. They are ensuring that when the current monetary paradigm shifts, they have a seat at the new table. It is important to understand that this process is often disguised by volatility. There will be months, even years, where the narrative flips, where Chinese markets crash, or where the US dollar rallies. These are the waves on the surface. But the tide, the deep structural movement of liquidity, is driven by fundamentals that cannot be argued with. A nation cannot run trillion-dollar deficits forever without consequences. A central bank cannot monetize debt indefinitely without destroying the purchasing power of the currency. These are laws economics that have held true from Rome to Weimar to present day. The tragedy of this cycle is that the average citizen is almost always the last to know. The general public reacts to the political narrative. They wave the flag and support the trade wars, believing that their leaders are protecting their economic interests. They keep their savings in the local currency, trusting that the government will preserve its value. They view inflation as a temporary annoyance rather than a structural feature of a dying system. Meanwhile, the institutional architects act on the math. They understand that inflation is the mechanism by which the government defaults on its promises to the citizenry. By devaluing the currency, the state effectively reduces the real value of the debt it owes. It is a soft default, but for the saver, for the retiree on a fixed income, for the worker whose wages don't keep up with the cost of living, it is catastrophic. It is a slow-motion confiscation of wealth. When we look at the hyperinflation of the Weimar Republic in the 1920s, we often view it as a sudden, chaotic event. But historical records show that the industrial tycoons and the well-connected financiers had moved their wealth into foreign currencies and hard assets long before the German mark collapsed. They used the devalued mark to pay off their debts and buy up real assets for pennies on the dollar. The destruction of the currency was a transfer of wealth from the middle class, who held paper money, to the asset-holding class, who held factories, land, and foreign reserves. The parallels to our modern situation are uncomfortable. We are seeing a massive bifurcation in the economy. Asset prices, stocks, real estate, luxury goods are soaring, driven by the excess liquidity pumped into the system. The wealthy who own these assets are getting richer. The working class who rely on wages and cash savings are seeing their standard of living erode as the cost of essentials climbs. This is not transitory inflation. This is the currency seeking its true value relative to the massive supply that has been created. The shift of capital to the east is simply the geopolitical dimension of this same phenomenon. The financial elite are diversifying out of the dollar system because they know the dollar system is mathematically constrained. They know that the only way for the US government to keep the lights on is to print more money, which further degrades the currency, which forces more capital to flee. It is a feedback loop that has no painless exit. So where does this leave the individual investor? The first step is to break free from the illusion that the status quo is permanent. The post-World War II economic order dominated by the US dollar. American financial hegemony is an anomaly in history, not the rule. It is an era that is drawing to a close. This doesn't mean the United States will cease to exist or that it will become a third world country overnight. Empires decline slowly, but it does mean that the automatic assumption that the US dollar is the safest store of value is no longer valid. We have to recognize that holding all of one's wealth in a currency that is being actively debased is a guaranteed losing strategy. The risk-free rate is a myth when the currency itself is the risk. The traditional 60/40ths portfolio, heavily weighted in government bonds, is a relic of a low inflation era that is likely behind us. The current environment demands a hard look at what actually constitutes value. Throughout history, during these periods of transition, value flows to things that cannot be printed. It flows to productive land, to commodities, to industrial capacity, and to gold. And as we are seeing with the institutional flows, it flows to jurisdiction that are on the ascending side of the production cycle. There's also a significant psychological component to this transition. It is difficult to bet against the system you grew up in. It feels almost treasonous to acknowledge that the economic power is shifting away from home. But successful investing requires a detachment from emotion. The British investor in 1910 who refused to diversify into American assets out of loyalty to the crown eventually saw his family's wealth evaporate. The American investor today who refuses to acknowledge the rise of Asia and the structural weakness of the dollar faces a similar risk. We must also consider the role of technology and digital assets in this transition. For the first time in history, we have the potential for a decentralized alternative to the sovereign debt model. While the sector is fraught with speculation, the underlying drive towards non-currency sovereign stores of value is a direct response to the failure of central banking. It is the market's attempt to build a lifeboat that isn't tethered to the sinking ship of national debt. Whether this will succeed remains to be seen, but the impulse is undeniable. The crucial takeaway is that the trade war and the political bickering are merely the surface denies of a much deeper tectonic shift. The integration of global financial markets means that capital is fluid. It does not respect borders. The walls that politicians claim to be building are permeable to money. While Washington and Beijing trade insults, Wall Street and Shanghai are trading wires. The financial integration is deepening, even as the political separation widens. This paradox is the defining feature of our time. It is a period of great deception where the official narrative masks the underlying reality. The debt is unpayable. The currency is being sacrificed to keep the system afloat, and the architects of the system are already executing their exit strategy. They are moving assets, securing footholds in emerging markets, and hedging against the decline of the dollar. The window to act on this information is narrowing. In the early stages of a currency crisis, the signs are subtle. Prices creep up. Volatility increases. Strange anomalies appear in the bond market. But by the time the crisis becomes front-page news, the opportunity to protect oneself has usually passed. The capital controls are implemented, the windows are closed, and the wealth transfer is submitted. We are currently in the phase where the door is still open. The flows are visible if you look for them. The data is public. The major institutions are showing their hand by what they buy, not what they say. They are betting on a world where the US dollar shares the stage rather than owning it. They are betting on a world where commodities and hard assets outperform paper promises. They are betting on the inevitable completion of the cycle. This is not a message of doom, but of preparation. History is cyclical. The seasons of the economy change just as surely as the seasons of the year. We enjoyed a long summer of dollar dominance and debt-fueled consumption. Now the leaves are turning. The smart money is putting on a coat and preparing for a colder climate. The question is, are you watching the weather report, or are you still just listening to the noise? Understanding this dynamic is the single most important factor in preserving wealth over the next decade. It requires ignoring the bluster of the 24-hour news cycle, focusing intensely on the quiet, massive movements of the global ledger. The trade war was a distraction. The real war is the war for capital preservation in an era of sovereign insolvency. And in that war, the only winning move is to align yourself with the reality of the flows, not the rhetoric of the politicians. The machine is in motion. The transfer is underway. The only variable left is how quickly the rest of the world wakes up to what the financial elite have known for years.